Welcome back to One More Bitcoin channel.
Hey, great to be here.
Yeah, so what if I told you that Bitcoin's sudden, violent surge past $80,000 this month wasn't primarily driven by true believers making long-term investments,
Right.
but, by a massive automated $3 billion trap?
It's pretty wild to look at.
It really is. Today, we are doing a deep dive into the August 2026 breakout, dissecting the historic short squeeze that basically forced the market higher and examining what this mechanical event means for the months ahead.
Yeah, there's a lot to unpack.
Definitely.
Hmm.
But before we get into the heavy analysis, make sure to hit that subscribe button to the One More Bitcoin channel so you never miss our future deep dives.
For sure.
And just a quick note on our source material for today. The insights we are unpacking come directly from the One More Money blog. If you prefer the written version, you can go to onemoremoney.com to read the full article by clicking the link in the description below.
It's a great read, honestly.
Yeah, it really is. So let's get into it. It really is a fascinating sequence of events to reconstruct.
Oh, absolutely. I mean, the timeline in the One More Money blog, it pinpoints August 25th as the moment the dam just broke.
Yeah?
Bitcoin shattered its holding pattern, cleared $80,000, and actually hit a session high of $81,023.
Wow.
Yeah, that represents a gain of over 25% in just a single week.
That is a staggering jump, especially when you consider how stagnant the market was right before that.
Right, it was practically asleep.
Exactly. For 6 solid weeks, from early July to mid-August, Bitcoin was just trapped in this incredibly tight corridor between $62,000 and $66,900. Watching that daily chart, it felt like watching a tightly coiled spring being compressed more and more.
That's a great way to put it.
The sideways action was almost agonizing. I kept wondering what was going to eventually make it snap.
Yeah.
And when that spring finally uncoiled, it didn't just bounce, it practically launched itself into orbit.
That coiled spring metaphor is, well, it's the perfect way to visualize the market structure at that moment.
Right. But the energy compressing that spring, it wasn't just boredom or, anticipation.
Okay, what was it then?
When a market trades in a tight sideways range for a month and a half, something really dangerous happens beneath the surface in the derivatives market.
Oh, the leverage.
Exactly. It allows a massive buildup of leveraged bets. And that buildup is the real engine behind a 25% rally.
But risk engines don't just buy billions of dollars of Bitcoin without a trigger.
Right. No, they don't.
I have a hard time believing it was just driven by passionate buyers waking up and deciding they suddenly loved Bitcoin at $70,000.
You're right to be skeptical. The dominant force pushing the price up was entirely mechanical, not emotional.
Okay.
We witnessed a massive wave of forced liquidations.
Right.
For listeners familiar with traditional investing but perhaps, new to the specific mechanics of crypto derivatives, a forced liquidation happens when a trader makes a leveraged bet using borrowed money.
Okay, so they're borrowing to amplify their returns. Exactly. And in this specific scenario, they were shorting the market. So they were betting the price would go down.
Right.
To make that bet, the exchange requires them to put up collateral.
Like a security deposit.
Yeah. Exactly like that. But if the price goes up instead of down, their collateral eventually isn't enough to cover their mounting losses.
And the exchange's risk management software isn't going to politely text them asking for more money while the market is running away.
Not at all. It's totally ruthless.
Yeah.
The exchange's risk engine steps in and automatically closes the position to protect the house.
Wow.
And here is the critical mechanism. To close a short position, the automated system is forced to buy the underlying asset at whatever the current market price happens to be.
Whatever the price is.
Whatever it is. It is not optional. It is completely price insensitive.
Yeah.
And it executes regardless of whether any human being thinks Bitcoin is actually worth that premium.
Man, I understand why the exchange forced them to buy once the price went up. But why were so many traders heavily betting against Bitcoin in the first place when the price was just moving sideways for 6 weeks?
Well, what's fascinating here is how comfortable traders get during those quiet sideways periods because of a mechanism called funding rates.
Okay, funding rates. Break that down for us.
Sure. So in crypto perpetual futures, the funding rate acts as a fee. It's transferred between the long and short traders to keep the derivative price tethered to the actual spot price.
Okay, so it balances the market.
Exactly. Now, when the market leans heavily bearish and a ton of people are shorting, the funding rate turns negative. That means the people betting the price will go down actually get paid a yield by the long traders just to hold that position.
Wait, so they are literally being paid a passive income to wait in a market that isn't moving.
You got it.
That explains why the bets got so overcrowded. I mean, it felt like free money to them.
It did, but comfort breeds complacency.
Yeah.
When the price finally ticked up past their liquidation thresholds, all those heavily leveraged, highly clustered positions were hit at once. It's just a domino effect.
A huge one. The data pulled from the One More Money blog is astounding.
What are the numbers?
Well, between August 19th and 20th alone, roughly $2.77 billion in short positions were liquidated.
Almost $3 billion.
Yeah. And compare that to a mere $264 million in long liquidations.
Oh, wow.
That means 92% of the forced closures were on the short side. At peak velocity, about $1.29 billion in shorts were wiped out in a single hour.
Okay, let's unpack this. So a huge chunk of this $80 K price tag isn't people who believe Bitcoin is inherently worth $80 K right now. It's just automated computers forcing them to buy at any price.
That is the X-book definition of a short squeeze.
Oh.
Yeah, it's a self-feeding cycle. The automated buying from the first batch of liquidations drives the price up, which then hits the next tier of liquidation thresholds.
Which forces even more buying.
Exactly. It forces even more automated buying. It's vital to understand that a short squeeze is not a sign that massive new buyers have entered the ecosystem.
Right. It's a sign that sellers have been forcibly ejected from it, and the momentum stops the moment there are no more shorts left to squeeze.
That makes total sense.
Yeah.
But a risk engine doesn't just wake up and buy $3 billion of Bitcoin out of nowhere.
No, it doesn't.
Something had to push the price up slightly in the first place to trigger that initial domino.
Right, the initial spark. And that didn't even originate in the crypto markets.
Really? Where did it come from?
It came from Washington, specifically the mechanics of the bond market.
Okay, color me intrigued.
On August 19th, the U.S. Treasury announced it was expanding its long-dated bond buyback operations.
Okay.
They doubled the maximum size from $2 billion to $4 billion per operation. They were aiming to relieve pressure on the 30-year Treasury yield, which had climbed to levels we hadn't seen since, 2007.
Wait, hold on. They increased a buyback by just $2 billion.
Yeah, just $2 billion.
In the grand scheme of the U.S. Treasury and global bond markets, I mean, that is an absolute drop in the bucket. How on earth does a tiny tweak like that spark a multi-billion-dollar crypto rally?
I know, it sounds negligible in absolute terms, but markets trade on signals and liquidity conditions.
Okay.
If we connect this to the bigger picture, many traders immediately started calling this stealth QE, or quantitative easing.
Right, stealth QE.
Now, that is a severe overstatement.
Is
Yeah, a Treasury buyback simply swaps one government liability for another. It does not expand the Federal Reserve's balance sheet the way actual quantitative easing does.
Okay, I see the distinction.
But risk assets, including crypto, are hypersensitive to any intervention.
Right.
When algorithms and macro traders saw the Treasury stepping in to manipulate yields, they interpreted it as a loosening of financial conditions and basically front-ran the liquidity.
And the political climate provided a pretty convenient tailwind that same day, didn't it?
The timing definitely amplified the signal. Also, on August 19th, the White House hosted a high-profile crypto meeting. Right, I remember that.
Yeah, with executives from Coinbase, Gemini, and Ripple. The administration was reportedly urging Congress to pass the Digital Asset Market Clarity Act to maintain U.S. competitiveness.
Which was huge news.
It was. And on top of that, the day prior, the SEC formally proposed new crypto fundraising rules, including a $75 million exemption.
Man, Treasury liquidity signals, White House meetings, and softer SEC rules. That is a potent narrative cocktail.
It provided a very supportive backdrop, for sure. But to your earlier point about the $2 billion being a drop in the bucket, the bond market itself essentially called the Treasury's bluff.
Really? What happened?
Within a single day, 30-year yields rebounded and erased their entire move.
Oh, wow.
The traditional markets just shrugged it off, yet Bitcoin kept skyrocketing.
Because of the shorts.
Exactly. Those macro and political catalysts only explain the initial spark. They lit the fuse, but the billions of dollars in crowded, complacent shorts were the actual powder keg.
Right.
Once it ignited, the macroeconomic reality didn't matter anymore. The risk engines took over. That is wild.
Yeah.
Once that fuse was lit, we essentially saw two entirely different types of buying happening simultaneously, right?
You did.
We have the mechanical side, but there was also genuine demand mixed in. Let's dig into that.
Sure. Looking at the mechanics first, the automated buying from the derivatives exchanges was immense, and the geography of that volume points to a major structural shift.
How so?
Well, Binance, which is the largest centralized exchange in the world, handled about $518 million in liquidations.
Okay.
But right on its heels, absorbing roughly $513 million was Hyperliquid, which is a decentralized exchange.
Wow. That is a staggering metric. Decentralized perpetual exchanges are now matching the volume of the traditional centralized giants step for step.
Yeah, leverage hasn't left the ecosystem. It has just migrated on-chain.
Interesting.
And this actually makes it somewhat easier to observe through metrics like open
Right,
interest.
right.
Instead of relying on opaque exchange data, you can look at the open interest. For those wondering, that's simply the total number of outstanding derivative contracts that haven't been settled yet. You can see it right on the blockchain.
That transparency is nice.
It really is. But while the derivatives market was chaotic, we can't ignore the spot market.
Right. And for our listeners, when we say spot, we're talking about actual, non-leveraged institutional demand.
Yes.
This is money buying the underlying asset itself, largely through the spot ETF flows. And according to the One More Money blog, this wasn't purely a synthetic rally.
No, not at all.
Genuine spot demand actually showed up.
The spot ETF flows were legitimately strong. BlackRock's IBIT fund led the charge with roughly $1.33 billion in weekly inflows right as Bitcoin was breaking out.
That's a huge number.
It is. That represents real capital allocation from investors, not a risk engine indiscriminately hitting the buy button to cover a margin call.
You know, I like to think about the contrast between these two types of buying using a real estate analogy.
Let's hear it.
So the spot ETS inflows are like families buying a house to actually live in.
Okay.
It's stable, recurring demand, and they plan to stay for years. The derivative liquidations, though, are like a frantic bidding war between a bunch of desperate flippers who borrowed way too much money.
Right.
And they're legally forced by the bank to cover their debts at whatever price the seller demands.
That's a perfect way to put it.
It creates a massive amount of buying volume, but it's fundamentally temporary. They aren't holding the property, and they definitely aren't coming back to buy another one next week.
Exactly. Taking that real estate analogy a step further, the bid from those families buying through ETFs can continue next week, but the bid from the squeezed flippers cannot.
Because they're gone.
Right, because their derivative positions simply no longer exist. They have been entirely wiped off the board.
Because that temporary, flipper buying was so massive and violent, the underlying structure of the market has to be showing severe strain right now. We've pushed up incredibly fast.
We really have, and the technical data in the One More Money blog makes this strain very clear.
Let's talk about the technicals then.
We need to look at the Relative Strength Index, or RSI.
Okay, for people new to technical analysis, what is that?
Think of the RSI like a car's tachometer. It measures how fast the price is moving over a given period.
Right.
Traditionally, if that needle hits over 70, the engine is redlining. The asset is considered overbought and prone to a pullback.
Okay, so where's the tachometer sitting right now after this $80,000 break?
The One More Money blog notes Bitcoin's daily RSI has been revving between 82 and 84.
Oh, wow. That is hot.
Extremely hot. And the strain isn't isolated to Bitcoin either. The entire altcoin market was pulled up in the draft.
Yeah, like Solana.
Exactly. Solana's 14-day RSI pushed up to around 81.74. Across the board, prices extended significantly above the 20-day, 50-day, and 200-day moving averages.
And I imagine sentiment is just as extended.
Oh yeah. The broad fear and greed index is sitting firmly at 74, which indicates heavy greed.
Yeah, the momentum is red hot, but we really need to keep the wider historical context in mind here.
Definitely.
I mean, $80,000 feels like an incredible high, but fundamentally, this is a recovery rally, not new price discovery.
Right, we've been higher.
The local high for 2026 was $94,820 back in mid-January, and the actual all-time high is still $126,198 from October 2025.
Which raises an important question about how we interpret momentum indicators during a recovery.
How so?
Well, a tachometer hitting 80 doesn't guarantee the engine will explode immediately. Strong trends can stay technically overbought for a remarkably long time.
Right, irrational markets and all that.
Exactly. But what it does tell you reliably is that the easy part of the move is behind us.
Yeah.
The cheap, abundant fuel provided by the short sellers has been completely burned through.
If the technicals are that stretched and the mechanical fuel is gone, the market desperately needs a strong, forward-looking narrative to stay afloat at these altitudes.
It absolutely does.
And right now, the primary narrative holding things up seems heavily reliant on some pretty shaky legislative hopes regarding the Clarity Act.
Yeah, the Clarity Act. For those who aren't following Washington closely, that is the piece of legislation attempting to finally draw a formal jurisdictional boundary between the SEC and the CFTC.
Right, clearly defining what constitutes a security versus a commodity.
Exactly. The crypto market is pricing in a massive wave of optimism right now because there is a scheduled Senate vote on September 15th.
But we need a massive reality check on what that September 15th vote actually represents, because it is not what social media thinks it is.
No, it's really not. The September 15th date is merely a cloture motion.
A cloture motion.
Yeah, it is a procedural vote to decide whether the Senate will even agree to begin floor debate on the bill. It is not a vote to pass the bill into law.
And that procedural vote is in a simple majority, right?
Right. A cloture motion requires 60 votes to overcome a filibuster.
The math in the Senate right now makes that incredibly difficult. I mean, Republicans currently hold 53 seats. That means even if every single Republican votes in perfect uniformity, at least 7 Democrats or independents have to actively cross party lines just to start the conversation, let alone pass the law.
Exactly. And if you look at prediction markets where people are putting actual capital on the line rather than just posting opinions, the optimism fades dramatically.
What are the markets saying?
Well, traders on Polymarket are pricing the odds of the Clarity Act passing in 2026 at only about 17%.
Wow, 17.
Yeah. And the analysts at Galaxy Research are even more conservative. They're estimating the likelihood of passage at around 10%.
Here's where it gets really interesting. If the smart money betting real dollars says there's only a 1 in 6 chance of this passing, the market isn't pricing in the law, it's pricing in the vibe.
The vibe, exactly.
Traders are using the mere existence of a scheduled vote as a convenient excuse to maintain the momentum.
But relying on vibes is a very dangerous game to play when your daily RSI is sitting at 84.
Right.
A failed cloture vote on September 15th could effectively kill the bill for the remainder of the legislative session.
Just dead in the water.
Yep. That would instantly kick out the primary narrative pillar supporting these elevated prices.
So, if we are coasting on vibes and a graveyard of exhausted short sellers, how do the next few months actually play out? Let's walk through the scenarios, starting with the bull case.
Sure. The bull case relies entirely on those families we talked about earlier.
The spot ETFs.
Yes. If recurring organic spot ETF demand continues to flow in, and if the U.S. Treasury buybacks, which are scheduled to run until November 4th, by the way, continue to signal supportive macro liquidity,
Right.
then the market can absorb the technical strain. In that scenario, the old stubborn resistance ceiling of $66,900 flips and becomes a highly durable floor of support.
Okay, that's the bull case. But the bear case is steering right at us too.
Yeah.
And it involved those same derivatives mechanics we just explored.
It does. In the bear case, the market has to reckon with the fact that its biggest forced buyer, the risk engines liquidating billions in shorts, is totally gone. The market is technically overextended. A failed cloture vote on September 15th bursts the regulatory narrative. But here's the most dangerous part.
Okay, what's that?
Because the shorts have been wiped out, all that leverage has room to migrate. Traders become overly confident and crowd onto the long side, borrowing money to bet the price will go to $90,000.
Oh, man. And if the price dips instead, we get a reverse cascade.
Precisely. If leverage crowds the long side, they establish new liquidation triggers just below the current price.
Right.
If spot demand softens and the price naturally dips, it hits that first layer of long liquidations. And to close a long position, the risk engine is forced to sell Bitcoin at market price.
Which pushes the price down further.
Exactly. That sudden automated selling pushes the price down, hitting the next layer of liquidations, causing more automatic selling. It creates a mirror image of the squeeze we just witnessed, but driving the price violently down through the floor.
A long squeeze cascade. So what does this all mean? When you weigh the bull case of ETF inflows against the bear case of a long squeeze cascade, what is the base case here? What is the hinge point?
The base case, the hinge that will dictate the entire remainder of 2026, it comes down to one single metric.
Which is?
Whether stable, verifiable spot demand from the ETFs can show up and maintain sustained volume above $70,000.
Real demand.
Real demand has to be strong enough to replace the temporary mechanical momentum of the short squeeze. If institutional buyers don't step in to build a foundation at these new heights, gravity takes over.
Given this incredibly delicate balancing act between spotting true demand and watching for derivative exhaustion, How should someone actually approach this environment?
Well, first, we need to be highly explicit about risk.
Absolutely.
Cryptocurrency is an intrinsically volatile asset class. The prices can move violently up or down at any hour of the day or night, and you can absolutely lose the capital you invest.
So with that said, who should definitely be sitting on their hands right now?
Anyone who considers themselves a casual retail investor looking to chase a green candle.
Yeah, FOMO.
When the RSI is printing in the mid-80s, the market is stretched thin. Retail investors who buy into an extended move purely based on FOMO, expecting guaranteed short-term continuation, well, they are historically the ones who get hurt the worst when the momentum breaks.
Right.
If your investment thesis is simply, oh, it went up yesterday, so it will go up today, you need to step back.
Good advice. On the flip side, who should be comfortable taking exposure right now?
Only those investors who are fundamentally comfortable with extreme volatility and who have the capacity to actively monitor the structural transition from mechanical demand to real demand.
Meaning they're actually watching the data.
Exactly. You need to be watching the order books to see if that old $66,900 ceiling truly acts as a fortified floor during a pullback. If you aren't prepared to monitor those specific shifts in market structure, this is a treacherous environment to enter blindly.
Bringing it all back to the big picture of what this means for the crypto space as a whole. Today, we've dissected automated risk engines, treasury bond yields, and institutional ETF inflows.
Yeah.
That is a whole lot of traditional financial architecture.
It leads to a deeply fascinating irony to mull over.
Let's hear it.
Bitcoin was conceived as an asset class built entirely on the ethos of decentralization. It was literally designed as an escape hatch from the mechanics of traditional centralized finance.
Right, peer-to-peer.
Yet, here we are in August 2026, and the single most violent defining price move of the year was dictated almost entirely by two highly centralized forces:
Which are?
the automated risk algorithms of corporate exchanges and the bond mechanics of the United States Treasury.
Wow.
It shows just how deeply intertwined this asset has become with the system it was built to disrupt.
The escape pod is now being steered by the mothership. That is a wild thought to leave on. Just a quick reminder before we wrap up. As we discussed today, crypto is highly volatile and speculative. You can lose your capital, so always do your own research and manage your risk. Thank you for watching. If you're interested in crypto investing and understanding the real mechanics behind these market moves, make sure to subscribe to the One More Bitcoin channel so you don't miss future videos. And please, leave a like and comment with your thoughts on today's topic. Do you think spot demand will hold the line, or are we destined for a long squeeze cascade? See you again in the next Crypto Deep Dive.